Hello students, myself is Parminder Singh from Prab Kirpa classes. Our today's topic is the sinking value, understanding currency depreciation. Have you ever wondered why the cost of imported goods fluctuate, or how a weak currency promotes tourism, or why our dream vacation abroad suddenly becomes out of reach? The answer may lie in the concept of depreciation, or rather, the concept of currency depreciation. In this course, we will understand the meaning of currency depreciation, how the currency depreciation affects imports, exports, and what are the reasons behind the depreciation of the currency of a country. We will also understand how currency depreciation affects tourism, whether it is beneficial for tourism or not. We will also understand whether currency depreciation has any impact on foreign debt. We will also understand whether central bank intervenes in case of currency depreciation. If yes, how it intervenes. As a whole, if you are a business owner or a frequent traveler or as a student of economics or interested in the subject of finance, this course is for you. Then you are going to learn a lot about the concept of currency depreciation. Now the topic before us is a look at currency depreciation. We may have decided to go abroad for some days, and we may have also thought that this will be the expenditure when we go abroad. But one day when we wake up, we find that our dream vacation abroad is now not possible. It may be also possible that we are using certain imported goods and the cost of imported goods has increased, and it may not be possible for us now to use that imported goods. What is the reason for all this? The reason for all this may be lying in currency depreciation. So what is the meaning of currency depreciation? Currency depreciation means a decrease in the value of domestic currency relative to other currencies in the foreign exchange market. What it means? We understand the same with the help of an example. We are living in India. If we want to go abroad, say USA, their currency is US dollar. To purchase one US dollar, we have to pay approximately 83 Indian rupee to get one US dollar. Suppose due to certain factors, such as suppose there is economic instability in India, or there is political instability in India, and the investors are losing confidence in the working of India. So there is economic slowdown in India. So due to all these factors, the value of Indian currency will depreciate. Suppose the value of Indian currency depreciates to 85. It means that to purchase one US dollar, now to purchase one US dollar, we will have to pay 85. That is, we will have to pay out more in Indian rupee to purchase one US dollar. Suppose we are importing a goods from abroad, say USA, and that particular item is imported good is say for one US dollar. And in other words, Before depreciation, we were paying 83 Indian rupee to import one US item. But when the depreciation has occurred, we will have to pay 85 Indian rupee to purchase that goods. So the purchasing power of the citizen where the currency has depreciated decreases. Now the topic before us is currency depreciation. How does it affect the cost of imported goods? First of all, we must understand what is the meaning of currency depreciation. Currency depreciation means that the value of your domestic currency has decreased in comparison to other foreign currencies. Suppose we are living in India and today we are getting $1 for say 83 rupee. But if after depreciation we have to pay 85 rupees for getting a US dollar, it is kept currency depreciation. So currency depreciation means you have to pay out more units of your domestic currency to buy the same amount of foreign goods or imports. In essence, imports become costly for domestic buyers. We will understand what we have said with the help of an example. Suppose $1 is equal to €1. We are here assuming, suppose. We also assume that a US company imports goods from France and the cost of one good or one item is equal to €1. When US is importing, so they will have to pay in euro, and €1 is equal to $1. So when a US company is importing in, it will have to pay out $1. Suppose there is depreciation in the value of US dollar. After depreciation of US dollar, suppose 1.2 US dollar is equal to €1. That is the value of US dollar has depreciated in comparison to euro. So to buy now, if US company is importing goods, it will have to pay. So now after depreciation, cost of one good is equal to 1.2 US dollar, because the cost of goods is in euro. It will, the import value is €1. Now if when the value of US dollar has decreased, US company will have to pay out more. That is, when it was earlier paying only $1 to purchase one item from France or to import one item from France, now the US company will have to pay out more, $1.2. So the cost of import increases on the depreciation of currency. We also take the real life example of Brexit vote 2016 in UK. UK remained the part of European Union for many years. In 2016, there was a referendum in UK to decide whether UK should remain part of the European Union or should opt out of the European Union. The referendum take place in June 2016. Approximately, we are using the word approximately 52% of the voters said leave European Union. About 48% of the voters said remain in the European Union. So with a very thin majority, the UK approved opting out of the European Union. When they opted out of the European Union, there was a very sharp fall in the value of, on that day when this referendum was approved, there was sharp decline in value of British pound, sharp fall on that day. And even that decline in the value of British pound continued for several months. As the value of the British pound has decreased in comparison to other currencies, the import of goods for UK, such as food items and such other items, automobiles, became expensive for the UK consumers. So many companies in UK were importing raw material also from other countries. So it also adversely affected those companies which were importing raw material from the other countries. So it adversely affected those sectors which were importing raw material and selling it after manufacturing the goods. So in nutshell, we can say that if there is currency depreciation in any country, the imports become expensive. Now the topic before us is, how does currency depreciation affect a country's exports? First of all, we will understand the meaning of currency depreciation. Currency depreciation means that your domestic currency becomes weaker in comparison to other foreign currencies. When the currency of a country depreciates, the exports from that country become cheaper for foreign buyers. That is, the foreigners are in a position to buy the same goods at less rate from the depreciating country. We will understand this concept of exports becoming cheaper for foreigners with the help of an example. Suppose USA is exporting cars to France. We have already learned that normally when a country exports goods to another country, the will of the exporting country prevails in receiving the payment. In which currency they will receive? Normally, the exporting country favors its own currency or the US dollar. Here, USA is itself sending goods abroad. We also assume that 1 US dollar is equal to 1 euro. That is, the value of 1 US dollar is equal to 1 euro. Euro is the currency of France, US dollar is the currency of USA. We also assume that the cost of one car is equal to $12,000. That is, the people of France will have to pay $12,000 or 12,000 euros to get a car from USA. Suppose the US dollar depreciates. After depreciation, 1.2 US dollar becomes equal to 1 euro. We are here only assuming that the value of US dollar has decreased in comparison to other currencies, and after depreciation 1.2 US dollar is equal to 1 euro. So now after depreciation, what is the cost of car? Cost of car will remain as it is in dollars. That is what they will have to pay. for France will have to pay the same $12,000 as earlier agreed. But what it will cost to people of France? The people of France will have to pay only 10,000 euros. Earlier they were paying 12,000 euros. Now they have to pay only 10,000 euros because the value of US dollar has depreciated, whereas the other currency, that is the euro, has increased. Euro has become stronger in comparison to US dollar. So when the currency depreciates, exports become cheaper. Here the cost of car has become cheaper for France, who were getting the goods from USA. We also take other real life example of Japan. During the 1980 and early 90s, the currency of Japan, that is Japanese yen, experienced significant depreciation in the value of their currency. During the period 1980 and early 90s, Japanese yen had experienced currency depreciation. Due to currency depreciation, what happened? The Japanese goods such as automobiles became cheaper for the foreigners. As a result of the depreciation of Japanese yen, automobile majors like Nissan, Toyota, Honda benefited a lot. Their cars became cheaper for the foreigners. These companies such as Toyota, Honda, Nissan were able to increase their market share in the foreign market, and it also increased the export volumes of Japan. So from this example we can conclude that when a currency depreciates, the exports become cheaper for foreign buyers. Now the topic before us is what makes a currency depreciate. There are many reasons as to why the currency of a country depreciates. We will understand the same one by one. First is economic factors. It may be possible that in any country there are lower exports revenue. If the exports of a country are continuously decreasing, it means that there is lower demand for your own currency, because when you export the goods abroad, normally you want the payment in your own currency, in your domestic currency. So when the exports are decreasing, the demand for your currency decreases and it results into the depreciation of your home currency. Increasing imports is also a reason for currency depreciation. When the imports of your country are increasing, that is, you are importing more and more goods from the foreign countries, it means that more money is going out than coming in. So it also adversely affected the values of your currency. Then it may be possible that a country is going through a economic slowdown. When there is an economic slowdown, the investors from the rest of the world do not come forward to make investment in your country. So it also reduces the demand of currency of that country, and it ultimately leads to depreciation of the currency. Second point is monetary policy. Sometimes, to boost the economy, the central bank of a country may reduce the interest rates. The central bank reduces interest rates to boost their economy. The investors who always look for higher interest rates do not come forward to make investment in that country, or may pull out their money from that country and make investment in those countries where there are high interest rates. So it also adversely affects the value of that country where there is currency depreciation. Sometimes the government of the country may also intervene. Government intervention is the another reason. Sometimes government may intervene and it may depreciate the value of its currency. That is, it may sell its own currency in the foreign market, foreign exchange market. Sometimes the political stability is not there in any country. So when the there is political instability, the foreign investors do not come forward to make investment in that country, or rather they pull out their investments from the country where there is political instability. So it ultimately results into the currency depreciation. Sometimes it happens that speculators believe that the value of a currency is likely to depreciate in the near future. Suppose if the value of Indian rupee is say 83 and it is equal to 1 US dollar. If the speculators believe that the value of Indian rupee is likely to fall to 85 Indian rupee equal to 1 US dollars, the speculators may start selling their holding in Indian currency, or they may not buy at all in the Indian currency. So when the speculators believe that the value of a particular currency is likely to decrease, it reduces the demand for that currency and it ultimately depreciates the value of that currency. We also here take the example of Venezuela. Venezuela currency is Bolivar. The currency of Venezuela has been in downward trend. The value of the Bolivar currency of Venezuela has been in downtrend trend for many years because there was corruption, mismanagement. Because of mismanagement, corruption, there was capital flight. That is, the investors pulling out their investment from that country. Excessive money was being printed in that country. Then there was political instability in Venezuela. Then there were wrong government policies which increased economic problems of the country. Even today, the Venezuela is facing a lot of economic problems. The currency of that country has even not stabilized properly. So the example of Venezuela shows us that there are adverse effects of if there is political instability, of if the government of the country resorts to excessive money printing, or if there is excessive reliance on a single export commodity. So in nutshell, we can say that there are many reasons for the currency depreciation in a particular country. If the currency of a particular country depreciates, it may be due to many reasons. We have already discussed all these reasons. These reasons may work together to cause to result into the currency depreciation. How much currency is depreciated, it may differ from country to country on the basis of various factors. Now the topic before us is the double-edged sword, how currency depreciation affects tourism. When the value of a currency depreciates, it means that the value of that currency depreciates in comparison to other foreign currencies. Currency depreciation has a double-edged effect on tourism. Currency depreciation impacts not only inbound tourism but also outbound tourism. We will understand the same with the help of example. Suppose we are living in India and here the currency is Indian rupee, and approximately 83 Indian rupee are equal to 1 US dollar. Suppose the foreigners from USA or the residents from USA make a program to visit India. They want to spend, say, 10,000 US dollars. So, if they come to India today, they may get 83,000 Indian rupee if they come today. At the current rate, we are approximately taking the value of Indian rupee. Exchange rate is in approximation. Eight lakh 3,000, 30,000. So, if the value of the Indian currency depreciates, suppose there is economic instability or there is some government intervention or due to some other reason, the value of Indian currency depreciates. What happens? Then suppose 85 Indian rupee become equal to 1 US dollar. That is, the people of US will now get 85 rupee in exchange of 1 US dollar. In return of their local currency 1 US dollar, if they come to India, they will get 85 rupee. So, if they come after depreciation of the currency in Indian rupee, now they will get 8 lakh 50,000, which they were earlier getting 88 lakh 30,000. Now they will get 8 lakh 50,000 for 10,000 US dollars. So the purchasing power in the hands of foreigners has increased. They can spend more Indian rupee while staying in hotels. They can spend more on hotels, food expenses, or buying goods and items in India. Earlier, they were in a position to spend only 8 lakh 30,000. Though they were spending only the same amount, 10,000 US dollars, but due to the depreciation of the Indian currency, they will now be spending more because the purchasing power in the hands of foreigners has increased due to the depreciation of our Indian currency. So it increases inbound tourism. That is, if the value of the Indian currency has depreciated, it increases inbound tourism. The India becomes attractive for foreigners. So it results into the boosting up of the tourism sector in India. Now, currency depreciation also adversely affects outbound tourism. How? We take example. Earlier, if today a person goes out, it will have to pay 83 Indian rupee to get 1 US dollar. Now, if a person in India decides to go abroad, suppose it decides that it will spend 10,000 1000 US dollars abroad, for which it will have to pay 83,000 rupee. In other words, the person has made a budget of 83,000, and in return of 83,000, when he goes abroad in US, he will get 1000 US dollars. So he will be spending 1000 US dollars abroad. But if there is depreciation in Indian currency and 85 Indian rupee become equal to 1 US dollar, that is, if after depreciation an Indian will have to pay 85 rupee to get 1 US dollar, so here the budget will have to increase. He will have to pay 85,000 Indian rupee to get 1000 US dollars. So when the budget expenses of going out will increase, so naturally the outbound tourism will decrease, because they will have to pay out more, which may the, the Indian person may not afford, or the resident of the depreciating country may not afford for the higher expenses, as the value of foreign currency has increased and the value of domestic currency has decreased. So the outbound tourism is adversely affected. The tourism in foreign countries is somewhat affected. So in the nutshell, currency depreciation not only affects the tourists which come into our country, but also affects the tourism industry in the other countries. Now the question before us is, if a country's currency gets weaker, does it become hard to pay back foreign debt? Why or why not? When the value of a currency, when the value of a country's currency depreciates, it means that the value of domestic currency depreciates and the value of other foreign currencies appreciates. That is, the foreign currencies become stronger in comparison to the domestic currency. Currency depreciation has a negative impact on foreign debt. It means that when the value of a country's currency depreciates, we have to pay, or that country has to pay more amount in domestic currency to pay back the foreign debt. Currency depreciation is negative one for borrowers. Now we will understand what we are saying with the help of an example. We are living in India. Suppose Indian government takes loan from US government. What is the present exchange rate? Approximately 83 Indian rupee is equal to 1 US dollar. This is the present exchange rate. That is, if we pay 83 Indian rupee, we can get 1 US dollar. Suppose the Indian government takes loan of 1 billion US dollar. Indian government has taken loan from US government to the tune of $1 billion. In other words, we can say that the loan taken by Indian government in Indian rupees is equal to 83 billion Indian rupee. This is the loan which has been taken by Indian government. Suppose today the government has availed loan. Say tomorrow or some days later, the value of Indian currency depreciates. It means that suppose it becomes equal to 89 Indian rupee. That is $1 is now equal to 89 Indian rupee. That is, by paying 89 Indian rupee, we can get $1. In other words, it means that the loan amount is now nearby equal to 89 billion Indian rupee. That is, though the loan amount is in US dollars, that is denomination is in foreign currency. When we have to pay back this loan, we will have to pay this loan in foreign currency. We will have to arrange for 1 billion US dollar, or the amount which comes due after deducting the installments. If we have paid some amount in installment, the same will be reduced. But we take it as principle that no amount has been paid. Then if there is no fluctuation in currency, the principal amount of loan remains 83 billion Indian rupees. But if the value of Indian currency depreciates to 89, from 83 to 89, then the amount of loan increases to 89 billion Indian rupee, because the loan amount is in foreign currency denomination. So what has happened after depreciation of Indian currency? The Indian government will have to pay out more 6 billion Indian rupee towards the repayment of loan. So the Indian government will be left with less amount left for investment, infrastructure development, or other social programs. Now, this point has also to be taken into consideration that what is the impact, how much impact currency depreciation has on foreign debt. If we have taken a very large debt from the foreigners, and the same has to be paid in foreign denomination, foreign currency denomination, then even a minor fall in the value of our domestic currency will result into big outflow. That is, the net result in case of large debt will be very big. It is also to be remembered that currency depreciation is a double-edged sword. On one side, currency depreciation has a negative impact on foreign debt. That is, it is negative one for borrowers. The borrowers will have to pay more in their domestic currency if the currency depreciates. On the other hand, currency depreciation is beneficial for the exporters, as the exports become cheaper for the foreign buyers. Now the topic before us is whether central bank intervenes in currency depreciation. Central bank generally may intervene in currency depreciation only in some cases. The first reason may be excessive depreciation. If the currency is depreciating excessively, it may destabilize the economy of a country. So, in case of excessive depreciation, the central bank may intervene. Second point is protecting importers. When there is currency depreciation, the imports become costlier. In other words, imported goods become pricey. We have to pay more to buy the imported goods. There are certain industries in every country which obtain raw material from the other countries. When the import of raw material becomes costlier due to currency depreciation, it adversely affects those sectors which are somehow depending on imports. So all those sectors which are related to the import of goods are adversely affected due to currency depreciation, and it may also result into job losses in those sectors. So to protect importers, the central bank may intervene. Third point is capital outflow. Sometimes there is sudden capital outflow. In other words, the investors may start sending their money abroad, or the investors may start pulling their investments from a particular country, which reduces the demand of the currency of that country, and so the value of the currency may depreciate. So in such like circumstances, when there is sudden capital outflow, the central bank may intervene. Now the question arises, how do they intervene? How the central bank intervenes? First is selling foreign exchange reserves. The central bank may start selling the foreign exchange in the market and purchasing its own domestic currency. That is, it artificially increases the supply of foreign currency in the market and reduces the supply of domestic currency in the market, and thereby ensures that the capital depreciation is not does not increase more, or the capital depreciation stops. Next point is raising interest rates. When the central bank raises the interest rates, the foreigners may start investing in the particular country. So it results into the inflow of foreign currency, and then the currency depreciation stops because the demand of the domestic currency increases. Now there are certain challenges before the central government in case it intervenes in currency depreciation. First is that market resistance. Large scale intervention by the central government can be very expensive and may not always be successful, because the foreign exchange market is very big, and as already told, foreign exchange market is spread all over the world. Next is reserve depreciation. When the central bank decides to sell foreign exchange reserves and purchasing its own domestic currency, then it may result into foreign it may result into depletion of depletion of foreign exchange reserves. So if it starts selling foreign exchange reserves, ultimately it may not have any foreign exchange reserves with it, which will adversely affect its international trade. So this limits the central bank's power to intervene in the currency depreciation. Overall, the central bank may intervene in currency depreciation, but it has its own limitations. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.